Welcome to the Bridge Capital Market Observations Call for the week of March 13th, 2023. I'm your host, Eric Jefferson. To kick things off here, I have a few quick words from our legal team. With that, we can go ahead, dive right in. And for today's call, I want to focus on the recent market volatility. Last week, we saw the S&P trade down nearly 5%, wiping out all of their year-to-date gains. A catalyst for that volatility was the fairly unexpected collapse of the Silicon Valley Bank, SVB. That is a name that has been in the headlines as of late. One of the largest regional banks in the country. At one point, held nearly 200 billion in client capital, and then in a few short days, went from being the institution that it was to being insolvent. Not surprisingly, we've seen a few comparisons drawn between what happened with Silicon Valley and the 2008 global financial crisis. So with that, I wanted to take a couple minutes, first and foremost, just recap everything that took place, as well offer our thoughts and opinions with respect to today versus 2008, and then the broader economy. So starting with Silicon Valley Bank, as the name suggests, headquarters in the West Coast, catered to a very concentrated clientele list of venture capital and early stage technology startup firms. These were all companies that would spend a great deal of cash to fund their operations. And in light of the recent volatility, a lot of the traditional ways that these organizations would raise cash have all but dried up, things like initial public offerings. And so in a fairly short period of time, the bank saw a substantial portion of its clients withdraw some very large portions or dollar amounts of capital. That in turn then forces the bank to go in, sell some of their financial assets to be able to fund those client outflows. Now, just like any bank, Silicon Valley will take in client deposits via checking and savings accounts, will then either make loans or will typically buy very conservative investments. Their profit at the end of the day is the delta between what they make on those loans and those investments and what they pay via interest to clients in a checking account. In the case of Silicon Valley, over the last 18 months, they spent nearly $2 billion buying long-term government bonds. Those are treasury securities. They have virtually no credit risk. They're backed by the full faith creditworthiness of the US government, but in turn makes them very sensitive to changes in interest rates. As interest rates go up, as they have at a historic pace over the last 18 months in response to what have obviously been elevated levels of inflation, that in turn put very significant downward pressure on the value of those bonds in Silicon's investment portfolio. Now, fast forward to present day, Silicon sees a lot of its clients withdrawing their capital. They're now forced to sell a number of those bonds at steeply discounted prices in order to be able to fund those outflows. That obviously triggers some insolvency concerns. Once word gets out, you see probably the remaining clients from Silicon Valley withdraw their capital. In turn, bank needs to go in and sell more and more of their investments at lower and lower prices. Ultimately, that all snowballs into the point where they do actually become insolvent. And then we saw over the weekend, they were taken over by the US government. So first and foremost, when we think about what happened with Silicon Valley in the 2008 global financial crisis that was obviously driven by or led by the banking sector, from the seat I sit, I would view these as two very separate incidents. In 2008, the catalyst for volatility, catalyst for one of the fastest recessions we've seen, was very credit risky bonds on virtually every firm's balance sheet. In this case, these were government bonds. These are the safest credit instruments available. Unfortunately, it was some improper management with respect to interest rate sensitivity. That coupled with a very niche focused client base that ultimately triggered the collapse of this institution. When I think about, again, Silicon Valley and the broader banking system, today, regional banks, this was following a lot of the scrutiny and regulation post 2008. held to much higher standards today, have much stronger balance sheets and capital structures. Again, better positioned to weather a lot of this volatility. So when I think about Silicon Valley, in many ways, I view this as more idiosyncratic or specific to their organization, their clientele, and their mismanagement of duration versus a systemic issue with the banking system that could obviously have more catastrophic impacts on our economy. When I think about our economy, again, where in hindsight, I think Silicon Valley will be more noise, not do much in the way of having a major effect. I do believe, though, our economy does have some challenges ahead. Myriad of geopolitical issues that need to be navigated, but also I don't know that our economy has really felt the impact of higher interest rates thus far. It has been very resilient. That is a function of a very resilient consumer. At some point, though, we'll likely see that impact of higher rates take a toll. I think, if anything, this incident may in many ways sort of speed up the impact of a possible recession here. That's something. Do expect a slowdown in growth, whether we hit a technical recession or not. That will certainly be a function of how the data plays out. But all else being equal, if anything, the fact that bank recently went under, that may slightly increase or tighten the amount of scrutiny banks use on their lending standards going forward. Obviously, that is not going to necessarily have a positive impact on the economy, but more importantly, having a strong, sound, healthy banking system is ultimately what is going to allow our economy to be able to navigate any bumps along the way. From the seat I sit, again, I do believe our economy has some headwinds in front of it. I don't believe, though, that is directly impacted by what happened to Silicon Valley, nor would it be realistic to expect some contagion of what happened with this one institution, with the banking system more broadly. Hopefully that's helpful. As always, happy to discuss in more detail. If you don't connect, have a great rest of the week and St. Patrick's Day. Take care.